Every market has a moment where price explodes or collapses, and everyone insists it was emotional. But institutions know better. They know emotion is only the spark, and the structure is the fuel. A headline triggers fear, fear triggers selling, selling triggers liquidity gaps trigger volatility spikes trigger more fear, emotion starts the fire, but the structure spreads it. Markets aren't purely mechanical, they're mechanical systems influenced by emotional participants. Welcome back to the Risk Manager's Guide to Money. I'm your host, Jay Malcolm, and today we're breaking down market physics, the structural and behavioral forces that move markets, shape volatility, create cycles, and determine price behavior. Markets behave like engineered systems, people behave like humans, and the two collide every single day. Institutions model both, retail investors model neither. This episode is about understanding markets the way institutions do, as structured environments influenced by psychology, sentiment, narrative, and reflexive feedback loops. Markets aren't chaos, they're physics with emotion layered on top. Before emotion enters the picture, markets operate as mechanical systems. Market structure includes the order book, liquidity layers, market depth, execution pathways, bid ask spreads, and the mechanics of price discovery. These components determine how fast price moves, how far price moves, how violently price moves, and how liquidity absorbs or amplifies pressure. Retail investors see price, institutions see structure. Structure determines the behavior of the entire market. Emotion doesn't move markets alone. Emotion moves orders, and orders interact with the structure. Behavioral finance is not a side topic, it's a core market force. Emotional pressure comes from fear, greed, herd behavior, FOMO, panic selling, narrative chasing, and headline shocks. These behaviors distort structure and create volatility. Institutions treat emotion as measurable input. They track sentiment indexes, volatility signals, positioning data, narrative cycles, and crowd psychology patterns. Emotion is not random, emotion is patterned. Emotion becomes real the moment it turns into order flow. A headline doesn't move the market by itself, it moves people, and people move orders. A headline triggers fear, fear triggers selling, and selling begins consuming liquidity layer by layer. As liquidity thins, even small layers begin to create outsized price jumps. Those jumps trigger more fear, which trigger more selling, and the cycle accelerates. What looks like emotional chaos is actually a mechanical chain reaction. Human psychology interacting with structural constraints. Institutions watch the process unfold in real time. They track buy and sell pressure, liquidity consumption, slippage, market depth changes, and order book imbalance because these signals reveal how emotion is being converted into mechanical movement. Emotion is the spark, order flow is the mechanism, structure is the amplifier that determines whether the spark becomes a flicker or a full scale market fire. Volatility is not just math, it's sentiment expressed through math. Volatility physics includes standard deviation, variance, implied volatility, realized volatility, and volatility clustering, all of which describe how price behaves under pressure. But volatility psychology explains why that pressure emerges in the first place. Fear cycles, panic contagion, narrative acceleration, herd reactions, and reflexive feedback loops all contribute to volatility spikes that appear sudden but are actually the result of emotional buildup interacting with structural weakness. Institutions model both sides because they know volatility is rarely caused by numbers alone. It's often triggered by emotional cascades that collide with thin liquidity, crowded positioning, or fragile market depth. Volatility is the meeting point between human behavior and market mechanics, and understanding both sides is the only way to understand why markets move the way they do. Markets move on data, but they also move, and often more dramatically, on stories. Narratives create pressure waves that influence sentiment long before any official numbers change. Recession fears, inflation panic, rate cut optimism, geopolitical tension, earnings hype, and regulatory shock all shape how participants behave, often weeks or months before the underlying fundamentals shift. Sentiment becomes positioning, positioning becomes order flow becomes price. Institutions track narrative cycles because they understand that stories can move markets faster than statistics. A powerful narrative can create a self reinforcing loop where belief drives behavior and behavior drives price. In this way, narratives become a form of macro pressure that shapes the entire market environment. Institutions respond to structure, retail responds to emotion. Institutions analyze liquidity, measure volatility, model order flow, track positioning, and anticipate sentiment shifts because they know markets move according to structural constraints. Retail investors react to headlines, follow influencers, chase excitement, panic during drops, and buy during hype because they experience markets through emotion rather than through architecture. Both groups move markets, but institutions move them intentionally, while retail often moves them reflexively. This difference in behavior creates predictable patterns. Institutional accumulation during fear, institutional distribution during euphoria, and institutional liquidity provision during chaos. Understanding this contrast is essential because it explains why markets often behave in ways that feel emotional but are actually structurally driven. George Soros's idea of reflexivity explains how price changes alter perception, which alters price again. Reflexivity is the feedback loop where price influences belief, belief influences behavior, and behavior influences price. This loop creates bubbles, crashes, runaway trends, and self fulfilling narratives that can persist long after fundamentals stop supporting them. Reflexivity is the market physics interacting with human psychology in real time. When participants see price rising, they believe something positive is happening. That belief drives them to buy, which pushes prices higher, reinforcing the belief. The same dynamic occurs in reverse during declines. Reflexivity is one of the most powerful forces in markets because it can transform small moves into large ones and large moves into full scale market regimes. Institutions don't just survive volatility, they position themselves to benefit from it. Anti fragile positioning grows stronger under pressure because it's designed to convert chaos to opportunity. Volatility harvesting, liquidity provisioning, trend following systems, mean reversion systems, asymmetric exposure, and hedging architecture all allow institutions to profit from environments that destabilize retail investors. Anti fragile systems don't fear volatility, they feed on it. They use disorder as fuel, stress as information, and uncertainty as a source of advantage. When markets become emotional, anti fragile systems become more effective because they're built to thrive in conditions where others panic. Markets are not emotional chaos, they're structured systems influenced by emotional participants. Institutions see structure, psychology, order flow, sentiment, reflexivity, cycles, and pressure waves all interacting at once. Retail sees price and assumes randomness. Institutions see architecture and assume patterns. So, seeing the markets the way institutions do means seeing them as engineered systems shaped by human behavior, where every emotional reaction interacts with mechanical constraints to produce the price movements everyone calls unpredictable. Once you start to understand both the structure and the psychology, markets stop looking chaotic and start looking designed. So, if you remember one thing from this episode, remember this. The system is mechanical, the participants are humans. Institutions model both because they know emotion starts the move and structure determines its size. Markets aren't random, they're engineered and influenced. When you understand how emotion becomes order flow and how order flow interacts with structure, you begin to see markets not as unpredictable environments, but as systems responding to pressure in predictable ways. Thanks for listening to the Risk Manager's Guide to Money. If this episode helped you see markets the way institutions see them, through structure, psychology, and engineered volatility, share it with someone who trades in a world shaped by both physics and emotion. The more you understand the architecture behind price, the less chaotic markets become. That's all for today. If you haven't subscribed yet, now's a good time. I'll see you in the next episode. Signing off.